For more, Jonathan Sheridan joins us now from FIIG Securities. John, great to have your company there. Just want to get your view on how bond markets are really performing ahead of that ECB meeting tonight.
Yeah, good afternoon, Ingrid. To be honest, there hasn't been much activity going on in bond markets ahead of this meeting. I think it's the key piece of data that has been governing sentiment over the last few days, along with Ukraine, but that's been a bit up and down. So this is the key thing that people are watching. Leading on from that will be into the non-farm payrolls in the US on Friday night. So we've seen a couple of up and down days, 7 or 8 points in the US 10-year yield, but it was pretty flat overnight. Mildly weaker at about 2.4%.
So do you think Mario Draghi will act tonight? And if he does pull out some sort of form of stimulus, how will bond markets react to that?
I think they're fairly priced that in already, to be honest. I think he's been big on rhetoric and short on action so far. One concern is that he's got this program of targeted loans, which some of the offsiders have said they want to complete before they consider any more stimulus. But I think if that happens, the market will be very disappointed. Deflation is a key risk at the moment in the Eurozone, and they really want some action from the central bank in terms of stimulus to try and prop up the growth.
You say it's priced in that we could see action, so if he sort of surprises and doesn't pull any trigger or on any sort of stimulus and just sort of firms up his rhetoric, how do you think markets will react to that?
I think yields will rise fairly significantly for bond markets. They're expecting it. I think all the growth data that we've had has shown that growth is basically non-existent. Particularly, the key I think is coming out of Germany. They were ticking along fine and happy with the austerity program, and that was basically governing the ECB's behaviour across the rest of Europe, which was hurting the other economies. Now that Germany's slowed down a bit, they'll be more willing to give their support to a stimulus program, and I think that's what the market's priced in. Just
quickly on the Aussie dollar, because we've obviously seen it be very resilient against the greenback, and we've been seeing more and more positive data out of the United States over the last few sessions. What are you expecting for payrolls, of course, tomorrow night, and how might that impact the Aussie?
Yeah, look, I think that's the key piece of data at the moment for the US, along with GDP. All the comment from the Fed has been about labour markets, and that's the key piece of labour market data. So if that comes out strongly, then I'd expect some kind of sell-off in the Aussie. But that being said, we're still on a relative basis a very high yielding country, and that's where the flows of money are coming from, which is keeping the currency high. So at the margin I don't see that changing, so any action on the currency will probably be a bit limited.
All right, John, any other local bond market action that you're seeing?
Yeah, just interestingly, Commonwealth Bank issued $3 billion of bonds in the US overnight. They had a preference for fixed-rate bonds over 3- and 5-year maturity, which is the opposite to what we're seeing when the major banks have issued Aussie dollar paper recently. So the customers over there obviously have a preference for fixed-rate paper. But interestingly also that they had a very small allocation to floating comparatively in the 5-year space. So they think rates will be going up more in the 5-year term rather than the 3-year term. So that's the